Okay, I think we are ready to begin. A very warm welcome to all who have dialed in, and thank you very much for joining in for this webinar. This webinar is our inaugural banking webinar at Zamara, and I will be introducing the partnership that we have with Analytix Engine very shortly. The webinar is also part of a wider series of webinars that we've been running at Zamara. So feel free to check us out either on social media or on any of our social platforms. As I've mentioned, this is our first banking webinar, and we expect, based on the feedback received today, to have subsequent webinars targeting different ways in which you can build a resilient banking practice. Before we begin, allow me to lay a few ground rules. The first is I need to disclose that we are now live. We are live on Facebook and a few of our social media platforms. You also don't need to bother or get worried about taking too many notes as we go along, because we will share the slides to everyone who's registered. So I encourage everyone on the call, kindly proceed to register, and you will get these slides within 48 hours, together with a link to where the recording is. The recording should be up in 48 hours in YouTube as well. We've tried to structure this session a bit uniquely. We've gotten a lot of feedback and a lot of questions over the last couple of weeks and months during our consulting engagements with banks. And we've tried to structure this particular webinar to tackle some of those questions. However, should you have any questions as we progress, there's a Q&A tab at the bottom. We will do our best to answer your question during this session, but if we are not able to answer your questions, we will, during the session, we will try and reach out to you directly, or we'll also share our contacts later on so that you'll be able to contact us as well. So today we are discussing and focusing on building a leading credit function. And we begin with the whole discussion about risk-based pricing and TCF. And before I introduce our guests, allow me to introduce the firms, the two firms that will be present in this discussion. We say we go to the next slide. Zamara is a leading local financial services firm that is a leader on the pension space, in the insurance space, in the actuarial space, and now growing our roots on the banking space. We are very proud and privileged to be joined by members of the Analytix Engine team. Analytix Engine is a boutique data analytics firm that's in South Africa. And together with Zamara, that has a local presence in Kenya and also a regional presence across Africa, we believe we have a good mix between a good understanding of our local industry, but also we will be able to peg some of our discussions on global best practice. I'm very privileged to be joined today in the panel by the two CEOs of Zamara and Analytix Engine. You will be hearing from them shortly. Pravin, who has joined us, is an actuary and has been practicing for a very long time. He was a partner at Deloitte for about 14 years before he was appointed by Standard Bank in South Africa to head the customer analytics team. He's a qualified actuary, and he now is the CEO of Analytix Engine. Sandeep is the group CEO of Zamara. Most of you maybe must be aware of Sandeep due to his input in various discussions about our social benefits in Kenya, both pensions, insurance, and now in banking as well. We have Kevin Wissa, who is on the line as well, and he'll be shortly taking us through what we have seen in the local space on the banking front. He has over 7 years of experience and now heads our local banking team. He also has a master's from City University in the UK. And my name is Seth Chengo. I will be your moderator today, and I will be the one conducting and taking questions a bit later on. I'm a qualified actuary and a qualified accountant, and have over 10 years of experience, both locally and in Europe as well. So without taking any more of your time, welcome. As I mentioned, ask questions as we go. We will have a short quiz at the end, not really a quiz, but we'll have 2 or 3 questions taken as a poll. Feel free to share with us any information you'd like, and we're open for feedback. And without any further ado, allow me to introduce my colleague, Kevin Buisa, who will take us through the start of the presentation before handing it over to Pravin. Kevin Buisa, welcome.
Thank you, sir, for the intro. Before we get into the meat of the topic today, maybe allow me to introduce a brief background on the importance of pricing and treating customers fairly, specifically to the banking sector. In the recent past, we've seen cross-cutting developments in the Kenyan banking sector, starting with the amendment of the governing law with respect to the Banking Amendment Act 2016 that introduced the rate caps. We have seen product innovations aimed at improving financial inclusion. We have seen digital transformations agenda, case in point, the introduction of online and mobile banking ways of provision of banking services, joint ventures and collaborations between banks and different industries, case in point, telcos, and mergers, acquisitions, and the not so positive collapses of major banks in the recent past. When we look at the Banking Amendment Act 2016, this puts CBK in the mix of guiding the pricing practices of banks with respect to the credit facilities by capping the maximum interest rate that banks are able to charge to the clients to 4% of the central bank rate. And this introduced quite a bit of less legroom for these banks to price their products, and we saw quite a bit of vulnerability from those banks, as we can see in the next slide, and also implications of the dependence of credit facilities and the economy at large. In the period 2011-2018, as you can see in the graph, there was overall the return on equity, which is we calculated as the pre-tax profit over the total shareholder funds, was north of 30%, north of 25%. But with the introduction of the rate caps, we saw a dip in that return on equity, majorly due to the reduction in the loan accounts, as the more risk-averse people were actually left out from accessing credit facilities. These are also the MSMEs that were also deemed to be a bit risky, were also left out of accessing credit, with the banks focusing on the high net worth firms and individuals and providing them with the larger facilities and leaving out the more risky people. We had spillover effects over the period, and we saw a dip or a shrinkage in the GDP with the region of 0.4% in the first year, that is 2017, and 0.2% in 2018. And this led to efforts to try and reduce, or rather reverse, the rate caps. And a precursor for that was the involvement of CBK, bringing together the different players in the banking space to develop a banking sector charter that was a precursor to the removal of the rate cap. So what was the banking sector charter? The banking sector charter that was introduced last year in February was issued pursuant to Section 33(4) of the Banking Act, that gives CBK the powers to guide the operations of banks, and it was aimed to facilitate a market-driven transformation by focusing on fairness, where banks are now required to implement differential credit pricing by adoption of risk-based credit scoring techniques, and that's the theme of our webinar today. The BSC 2019 also introduced the need for transparency by banks, where banks are now required to provide full disclosures on all internal and external fees for all their products. It also had a requirement on financial literacy, where banks are now required to drive financial literacy initiatives, focusing mainly on those that were not previously serviced by the banks. And this, we're talking about MSMEs and the other people that are underbanked. It also had a requirement that banks push for a broader access to financial services to all people by embracing new technologies to serve all customer segments, including those that are underbanked. As I've stated, it was actually a precursor to the repeal of Section 33B of the Banking Act that was done in November 2019 that led to basically an end to the interest rate cap regime and ushering in the risk-based pricing regime. I will now introduce our keynote speaker, Praveen Burat, to take us to the topic of the day.
Thank you, Kevin, and good morning and hello to everyone. I thought it's a good place to start with just defining what is risk-based pricing. And you'll see there that I've actually chosen one of the definitions from the internet. In simple terms, risk-based pricing is about charging customers fairly for their risk. So for example, customers who are better risk should pay a lower risk-based premium, and customers who are a higher risk should pay a higher credit risk premium. Very importantly, in practice, risk-based pricing also tends to overlap with value-based pricing, in that the pricing framework will often allow discounts to larger and strategic customers of the bank. So while it's called risk-based pricing, it's risk and opportunity-based pricing. One very important thing, and each bank sets its own definition for this, is that it is becoming common practice that when doing risk-based pricing, factors that might be considered unfair or discriminatory are excluded from the pricing framework to make sure that the pricing is fair and equitable, both to the bank and to the customers. Next slide, please. Next slide, please. Thank you. If we look at the issues, I thought it's good to put the issues out before we go to the opportunities. If we look at the previous slide, sorry. If we look at the issues around risk-based pricing, the four common issues that arise, or that people raise. One, because each client is paying a different price based on his perceived value and risk, it's difficult for customers to shop around for rates without actually filling in a loan application. So it becomes difficult for consumers to make comparisons. This is both a threat and an opportunity. From a consumer perspective, it presents a bit of a challenge, but from a bank's perspective, it presents an opportunity to differentiate your service offering. So you can start pitching your product and positioning your product from a value perspective rather than just purely price, which from a relationship banking perspective specifically is quite important. The second is it can give rise to false advertising. So banks could have a range of prices from best risk to worst risk, and all the advertising only advertises the cheapest risk or the best risk group. So that when a customer comes into a branch, he has a perception of a very low price in his head. But when he starts filling in the credit risk questionnaire, he discovers, or the bank discovers, that he's actually high risk, and he ends up being charged a much higher premium for his credit risk. This is called bait and snatch. You first try and get them into your process to apply, and only after they apply, they realize they're paying a much higher premium than the one that's advertised. Responsible banks will advertise either the range or the average rather than necessarily just the best rate. The second, an additional concern is that it could discriminate against the bottom of the pyramid. So often if we look at those people who need funding the most, and those people with irregular income, for example, people in the manual labor market, for example, they are often perceived in traditional scorecards, in thin file scorecards, as presenting a much higher risk. And associated with that higher risk is the issue of a higher premium. And this is where the cost allocation becomes quite important in your pricing framework, in terms of how you choose to recover your cost, because it can have a huge impact on the minimum premium that you charge to the bottom of the pyramid. And the final one is the question of fairness. If you are going to charge different customers different premium rates, then how do we know that we are treating them fairly? And more importantly, how do we get our customers to feel that we are treating them fairly? That is quite important. And the effort on communication, as well as on making sure our frameworks are fair, become quite important. Next slide, please. Okay, I quite like this when I was doing my research. It says, when the drummers change their beat, the dancers must change their steps. And for me, this is quite important, because if we look to the issues that I mentioned on the previous slide, the question then becomes, why do risk-based pricing? And the honest answer is that once one bank starts doing risk-based pricing, the rest of the banks don't have a choice. Whichever bank becomes good at risk-based pricing, they are able to cherry pick the best customers in the market because they understand which customers present the lowest risk. They're also able to understand which customers and which customer segments have a lower risk segment, and which customers have a higher profitability segment, which means that once one bank starts cherry picking the better customers, the rest of the banks have to respond to it. And so in my mind, the genie's out the bottle. The drums will change, and it's a question of whether you're the dancer or the drummer. I think banks will have to proceed down the journey of risk-based pricing. If we look at risk-based pricing very simply, and we look at the two axes, the x-axis and the y-axis on this graph, on the left-hand side, we see low-risk customers, and on the right-hand side, we see high-risk customers. And then if we look at putting them into a pricing framework, some of them, preferably the low-risk customers, will receive a low premium, and the high-risk customers will receive a high premium. And these customers, we would say, are fairly priced. And so there's no real issue there. Next. If we then look at customers who are low risk, if they are paying the average risk and the same risk as everyone else, that means they are overpriced and overcharged, which runs the risk that other banks can come and steal these customers by offering them the correct risk-based premium for themselves. So potentially you run the risk on your overpriced customers of giving them away to your competitors. The converse is also true. If you've underpriced, you're then keeping your customers because you are cheaper than your competitors who are fairly priced, but then you're giving away margin, which is not a good thing either. So if we look at the top left and the bottom right, those are the boxes that typically give rise to issues in risk-based pricing. And those are the boxes specifically that you want to try and get right. Next slide. Okay, now if you're going to build a risk-based pricing framework, there's a number of practical problems that you would want to solve. And I've just listed a few here. So if we start on the bottom left and just follow the semicircle across, some of the questions that you might want to address as part of your framework are, how do I make decisions closer to my customer? Specifically, for example, in small business lending, in wealth segment lending, wherever you've got customers who are clever enough and financially savvy enough to negotiate rates. The question is, how do you make people who are closer to the customer, who understand the customer better, to negotiate the price? So how much discretion do you want to give to the branch or to the relationship manager versus having it enforced from the center through a statistical model? That's quite important. If we move up one bullet, it's how do I design profitable offers around all my customer segments? So coming back to the 4 quadrants and getting them right, in practice, you'd probably have a lot more than 4 quadrants. So 2 important questions you need to answer there. The first one is, how do I segment my customers and which segments do I focus on? And then once you've focused on the different segments, the question is, which customers make the most profit and which customers lose the most profit, so that you can do corrective actions. But the first important step is to segment your customers. The next one then is, how do I connect front and back office? And this is quite important. Front office, in my mind, is the channel that talks to the customer. So it could be digital, it could be branch, it could be relationship managers in your wealth segment and private bank. It's the front office is whoever talks to the customer. The back office is people sitting in head office. So the head of credit, the head of finance, the head of profitability. How do we make sure that we connect those two so that the conversations at the talking to the customer don't give away too much margin, but also that we respond to what the customers tell us in terms of, are we getting our pricing right? Are our value propositions good? That's very important. So as part of building our framework, when we look at executing on price, that's quite important to get right. The next one, which I think is a pressure for everyone who's in business today, is how do I grow? And it's important there. You've got scarce resources. You've got limited manpower at an executive level. You've got limited budget and limited capital. And so the question becomes, how do I optimize the scarce resources I have across multiple products and multiple channels? Think about your advertising spend. And so the important question you need to answer there is, what is my return on advertising spend in terms of economic value added? So if I were to sell more mortgages, how much more profit would I make based on a cost in shillings of spend versus, for example, selling more motor loans? And sorry, we missed the last bullet there. How do I improve the portfolio performance? And the important part there is, how do I increase margin? So per segment that you create, how do I optimize the margin per segment? And then how do I reduce risks? And reducing risks doesn't mean getting rid of risks. It just means charging the correct price for the risk so that the risk is fairly managed. Next slide. Okay, so if we look at the path to success, I've broken this down into 4 pillars that are quite strategic. The first one is to have your pricing principles right. So mathematicians and statisticians and your data science teams can build you a model. The question is that the model that you want to actually take to market? And the way to get that right is to start with your pricing principles. So I've asked 4 questions there, and you can ask a lot more questions internally. But some of the questions to ask is, should customers get the same price across all channels? So for example, in some channels, you might be paying a motor dealer a finder's fee for vehicle finance, you might be paying an estate agent a mortgage origination fee, etc. So if someone comes via one of those more expensive channels, should they get the same price? That's a philosophical rather than a mathematical question. And that's quite important. How much pricing discretion do we want to give to the front line? So how much negotiation space do we want to give to the front line when they're talking to customers? How transparent do we want our price to be? Are we happy that the frontline can explain the pricing principles to the customer? And more importantly, are we comfortable that if one of our customers is talking to his neighbor, both of whom bank with us, and they're comparing their prices, that they understand the difference? And then the last one is, should we maximize profit? And that sounds silly from a business context, but it's quite important. How much profit is enough profit? When are we fair and when are we excessive? And when are we not enough? Having a view of that is quite important. Those principles guide the price setting. When we look at the price setting, some of the questions we're looking to answer is, how do we segment our view of the portfolio so that we can set the price correctly per micro segment? So you might want to offer a discount to loyal customers, and you might want to be less willing to give a discount to customers who are just shopping around, because otherwise you force the price down. How do we recover our costs between marginal cost versus full absorption costing has a huge impact on the pricing and how steep or flat our pricing curve is, especially in banks where a lot of the cost is fixed overhead. It becomes quite important that we think about how we allocate costs into our pricing formula. How do we understand customer value? And when we look at customer value, it's the value of the current deal, but also the value of that customer to us over the long time horizon. Are we willing to lose a customer for a few basis points of price when that customer could actually be worth a lot to us over their lifetime? Are we modeling the cost of credit correctly is critical to risk-based pricing. If our models are sharp and if our models are correct, then we end up with the right credit risk premium that inputs into our final price. The converse is unfortunately also true, in that if our models are too blunt, we end up with average pricing, which then doesn't allow us to differentiate, and then we run the risk of losing customers or giving away margin. And the final one is, we mustn't just look at cash flows, but we must also look at the cost of capital, because in banking with Basel and other regulatory capital requirements, capital is quite intensive, and so we must make sure that our pricing allows for the capital that each loan facility attracts. Next. Once you've set your price, you obviously have to execute your price in channel. And this is almost as important, if not more important, than setting the price. So the first one is the front line properly trained in price negotiation? If the front line is incentivized on volume of loan rather than margin of loan, it's easier for them to give away margin and give discounts to customers to write business. It's important that they are educated on margin and risk as well as profit. It's also important that you give them simple ways of communicating. For example, a profit score between 1 and 10, rather than a complicated list of risk drivers of profitability. Do we have measures in place to effectively communicate customer value and profitability? And this comes back to the point I just made. If the front office and our customers understand how a bank makes profit, not in detail, but philosophically and at a principle level, it's easier for them to come and counteroffer us a fair deal. It's easier for our branch managers and relationship managers to negotiate because they understand the drivers. It also presents an opportunity for the customer to improve their behavior, to improve their score, which is quite important. What is our cadence of change? This is critical. So typically banks will go through a process at year end of reviewing their pricing bundles, etc. They then have to communicate this to all their customers, etc., make IT system changes, etc., before the new prices go live. And so making sure that your IT system is set up, that a lot of the key drivers of the pricing are parameters rather than hard-coded, makes it easy for the bank to make changes fast and more frequent. Because what we're seeing now with the COVID being a good case in point is that market conditions change fast. And the faster you can respond responsibly to those changes, the better. And then the last one is obviously we want to do all of these changes in channel. Can we do them with effective control? So what controls are needed to execute on price properly? Next one. And then once you've executed, the important part is again to monitor and control. So to some of the things you would want to monitor is the realized margin, so that you can see that the branch and channel are effective and getting the results that you expect. The return on the cost of acquisition is quite important, and that drives future investment in acquisition. In a down cycle, you don't necessarily cut your advertising. What you cut is the inefficient advertising. Change in demand is a good lead indicator to a segment that's either changing or that you are out of step with customer expectation. So if you start losing demand, people applying in a particular segment, it tells you that your value proposition may not be appropriate. So it's a good lead indicator. Change in acceptance rate is also a good lead indicator. It tells you that the customer either doesn't need it and is just shopping around, but assuming that that rate is constant, then a change in your acceptance rate may indicate changes in market pressure. Change in the take-up rate. The acceptance rate is you accepting customers in terms of credit risk. Take-up rate is the customer, after you've said yes, actually taking up the offer you've made. Market share is a good lead indicator, again, to the suitableness of your product. Stress testing and scenario analysis, and I cannot stress this enough. I'm wearing a business hat on this one, not a regulatory hat. The important part within a company is to try and run different scenarios through your pricing and to have a model that lets you forecast what is likely to happen. You won't know what will actually happen until you try, but you want to try and get an idea of the range of outcomes if you try different strategies so that you can reduce risk. So building a what-if model is very important. And then the last one is having more segments rather than less, and to manage performance on a segmental level, make sure that you run a lower risk of being mispriced. Moving on. So if those are the way you're going to go to market, what are some of the key models? And when I say models here, I'm talking statistical and data-driven models, because I like data a lot. One, from my background, and two, because data doesn't lie. The first one is segmentation. So how do we focus on micro segments beyond just income and age? So traditionally, banks have segmented their customers by income and age. And the question is, how do we segment our customers into more micro segments? Graduate professionals. Even if we look at people who work in industry, there's a big difference in skill levels between, for example, the foreman and the worker. There's a big difference between someone who's got a small family and a large family. So how do we segment our population meaningfully? That becomes quite important. The next one is the net present value of deals and the present value of the facility level, as well as the deal hurdle rates. That's quite important. And you want to have a model that sets that in advance, but also for every new deal that's written, that you can see that it meets the minimum criteria, but also where in the spectrum of criteria you want it to be priced. What is the return on capital for each deal, the net present value for each deal? Then you'd want to look at lifetime value, not just the one deal. Because, for example, a student loan to a university student is not very profitable. But if that student goes on to become a CA or a doctor, that lifetime borrowing from that person becomes very profitable. So taking too short a view of the customer is also not good. So having lifetime value models that look not just at the current products the customer has, but also the opportunity value of each customer becomes quite important. Forecast models, and I spoke a little bit about the ability to run scenarios and stress testing, are quite important to proactively manage your portfolio and to set your risk appetite. Elasticity is quite important. It tends to be one of the later models that companies build. Mathematically quite simple, getting the data becomes a bit more tricky. It's important to store your quotation data and your application data, not just the accepted live loan data, in order to build these models. The important thing here is to say, if you change your price by a little, how much does demand change? And that's what you want to try and get to. And then the final one is your marketing effectiveness. And marketing here is not next best action, which is a part of it, but rather every shilling that you spend on marketing, what is the return in profit for every shilling spent on marketing? So these are 6 fundamental models that I would say every bank would want to have in place. And often they may not just be single models. So segmentation may be a suite of segmentation models. Lifetime value may be a suite of lifetime value models. But as categories, these are quite important models that a bank would want to have in place. Next, and I think that is most of what I wanted to say. So I think we've got enough time for some questions. And I believe there was a poll as well. So back to Seth, do you want to take us forward?
Thank you very much, Pravin. And thank you very much for those people who are providing instant feedback. Some are providing it publicly. I see Moses Juma. Thank you very much for your feedback. Ladies and gentlemen, the presentation by Pravin and Buisa is just the start, as I mentioned, of a conversation. But we are very keen to listen from to you. Please send through your questions. There are some that have been sent to us previously before the session and even privately. So we'll begin with those shortly. But before we begin our Q&A session, we will be running a poll with 3 simple questions. This will help us to understand where you are as our participants and what you'd like to listen to. So over the next 30 seconds to 1 minute, kindly fill a poll. The questions should have come onto your screen as we speak. Feel free to share them with us, and we'll progress from there. Okay, just allow maybe 10, 15 more seconds, and we'll get going. All right, do we have enough feedback to share with the panel and the rest of the team on the line? All right, so keep submitting. Once you have a credible number, we'll display those up for you. Please feel free to fill it in, whether you are working in a bank, in a consultancy, you're just an interested party who's logged in. We are very keen to listen to you, so just keep filling in the poll, which will help in the insights. Bear in mind that today's session was actually structured around the questions that we received from you, so we do value your input. Okay, so whilst we wait for the feedback on the same, we have received a few questions, and I'd like to ask the panelists who can put on the videos, please do so. I know 1 or 2 may have challenges with the link. that they have. The first question here, I will channel it to Sandeep if he's on the line. And the question is interesting. Off the back of the discussion that we've just had about your risk-based pricing and modeling and the impact it would have in our banking businesses. Sandeep, do you believe that the Kenyan market is actually ready for the risk-based pricing that we are discussing? Bear in mind the recent banking sector charter that came last year. What is your view? Do you believe the Kenyan market is ready for this?
Thanks, Ed. I hope that everyone can hear me. I'm sorry, I've got an unstable connection. But yes, I mean, Seth, a good question. I mean, I'd like to say that, with all the changes that are happening in the banking sector and indeed the wider financial services sector, because of changes in regulations and accounting standards, I mean, there is a global shortage of skills in risk-based pricing, in modeling. But I think as Kenya, we have a fairly mature banking sector. We have been at the forefront of a lot of progress and innovation in banking. With our interactions with executives within banks, I see a lot of extensive experience and expertise. And I'm really happy that as Zamara, we have several actuaries now with the required and the necessary skills. And we're absolutely delighted with our partnership with Analytix Engine, because this enables us to leverage off their skills in financial modeling and data analytics to serve the Kenyan and wider East African market. We've already started this journey with a number of banks. And as Pravin said in his presentation, once one bank starts, I mean, every other needs to follow suit. And as Zamara, we're very able and keen to work with the banking sector on these areas of risk-based pricing, financial modeling, and some of the other things that Pravin talked about, including, analyzing the impact of your marketing strategies, your spend. So there's a fair amount that can be done and needs to be done. Back to you, Seth.
All right. Thank you very much, Sandeep. There's the questions are trickling in thick and fast. I'll try interpret them as they come in. There's a question that has come on data, and there's another one on the information available from the Credit Reference Bureau. Probably let me begin with the data one, right? And this can go to any of the panelists, preferably either Pravin or Wisa on this one. And it's an anonymous question. Okay, is the data available in banks? Is there data available in banks to basically carry out risk-based pricing of credit products? So basically, do we have enough out there to carry out the pricing that we're talking about? And if not, what process should we be following, to get to that point?
Okay. Maybe if I can start on that one. So I believe enough data exists to start risk-based pricing. If we looked at the types of models that I suggested, there were 6 modeling categories that I identified. I don't know if we can maybe just flick back to that slide. Generally, banks have enough data. What they battle with is accessing and using that data. So if you look at it, the pricing data is available in that every single account has its price. So we know what you're charging every customer. Your product admin systems and your risk data marts tell us about the credit performance of those customers. Your financial system as well as your product systems tell us the lifetime of those customers. So the data does exist. It exists though across different data sets, the product system, the finance system, the risk system. But they do definitely exist. The only one piece of data in my experience which tends to be weak is the storage of the actual quotation data. So the loans that are not actually taken up, either because we declined the loan or because after we quoted the customer, he chose not to take it up. And that's easily fixable by banks starting to collect that information today. So I would say definitely, while banks' data is not perfect, it definitely exists in a good enough quality to do 80% of the modeling that's necessary.
A very, very good response and a very good question as well. There's a question, and I was 99% sure that we would get a question on COVID-19. It's changed the way we do business. It's changed everything. There's a very good question on Maina Washeni. I will try and summarize it, but I'm not sure I'll give it the correct spin. If I don't, please just feel free to add additional comments on the question. And the question is twofold. One, there has been a suspension of CRB information provided to micro lenders based on the information that's coming in. And two, more recently, we have seen banks going slow or giving concessions to the customers due to the COVID-19 pandemic. Yeah, and a combination of those two, due to the ongoing environment, because of those two, do we believe there's new moral hazard that has been brought into the sector, and how should banks start dealing with some of the increased or heightened risks in light of COVID-19 and in light of limited credit information about the customers, and I guess even the wider whole data protection and how much information you can actually access. What should banks be doing now to protect themselves amidst all this?
Yeah, that's actually a very good question, and one for which there is not an easy answer. But if I try regardless, again, if we, on the same slide that's up at the moment, if you look at the key models, there's two important models here that become very critical in a COVID world. One is segmentation, and the other is lifetime value. Currently, in a world of less data, which is what's happening at the moment, because a lot of governments around the world have allowed people to take payment holidays without being blacklisted on a credit bureau. And that's not just a Kenyan thing, it's a global phenomena. Also, the entire world has changed in the sense that if you look at what the global credit bureaus are saying, they say that bank profitability will be negatively impacted for anywhere between 2 and 5 years, depending on who you listen to, because of COVID. And it's not just what's happening today, but what's going to happen to businesses over the next, businesses and employment over the next 48 months, with the next 24 being critical. So the important parts there for me is we don't know the correct answer. What we have to do is make the best decisions we can with the information we have. And for me, there, being able to segment your customer base into customers who are more likely to recover versus those that are not. So for example, a simple thing to look at, if we look at industries today, is people in the travel industry will be highly impacted by COVID because, for example, there are no flights and no one's traveling across borders. So immediately you'd expect more unemployment and poor company performance in the travel sector. However, in the grocery sector, for example, as more people stay home, grocery sales, etc., are starting to go up. So, for example, people in primary services are more likely to recover. Likewise, regardless of where we land, certain graduate professionals, such as modeling people, chartered accountants, and doctors, are always going to be in high demand. So, having views of different segments within your customer base allows you to respond differently to each of them. That's quite important. The next one that follows on from that is the forecast models. By being able to run scenarios for each of those segments in a simple model, think Excel here, to say what's the best case, what's the worst case, what's the likely case of each scenario, it allows you to set risk appetite. Because remember, you don't have to say no to something totally. What you might do is just reduce your exposure to certain sectors or to certain customer segments. It is challenging because we don't know which of our customers is likely to rehabilitate and which won't. And again, having a lifetime value view of those customers becomes quite important because it gives us a view based on past experience, which ones were worth a lot and which ones recovered a lot. So for example, if a CA gets retrenched because he happens to be working in the tourism sector, there's a high probability that he'll find a job in another sector. So on a lifetime value basis, you could say that hypothetically people who are CAs present less risk than people who aren't. Seth's quite happy to hear that. But again, there's no perfect answer. What's important is to use the information you have, such as it is, to make the best call that you can. Unfortunately, that is our reality.
Thank you, Pravin, and thank you, Sandeep and Busa, for the insights that are coming in. The questions are still coming in. Conscious we have about 14 more minutes to go. But what I'll do, I'll take a small break, and we will see the initial results of the poll. Ask if you could put the results up. And I'll be asking the different panelists. The first question is more informative in terms of the composition, and it looks very well balanced, actually. Okay, that's really good. Yeah, so we have a very good composition and spread of knowledge on the call, so that's a good one. But I'm not sure whether everyone can see the results of the poll. Pravin, can you see the results of the poll, and Busa?
I can see the results to question 1, so maybe just scroll down a little bit so that we can see.
Oh, okay, so as I scroll down, everyone can see that. Okay, cool. So the first question, what is your current role within the bank? We have a lot of leaders from the banking space, which thank you very much. We are very humbled that you joined, and financial analysts as well. We have enough credit people who have come onto the call as well, and operation, academia as well, and a lot of other. So that's a very good spread, and thank you for that. So maybe I'll summarize all 3 of them, and then we can comment on those questions. The second poll was, what project has your company prioritized? And the assumption being that your company is a bank, but what projects have they actually prioritized at the moment? So we've seen a lot of focus on scoring and pricing. That's no surprise given the charter that recently came out, but also the global push. We have it's interesting that IFRS 9 is only at 11%, because there's a significant push last year and the year before last to comply with IFRS 9. It would be very interesting to get initial feedback on what we've seen in the market on IFRS 9 modeling. Capital modeling, 0%, okay? But portfolio management is up there, and profit optimization. So the 2 big projects seem to be scoring and pricing, and portfolio management, possibly with the idea that IFRS 9 modeling has taken a bit of a backseat to the front too. The final question was, what is the maturity of the current project? And most of them are in the development. So if you combine 2 and 3, then you'd say that the biggest projects that banks are thinking about right now are scoring and pricing, and portfolio management, and those are ongoing projects. Does that surprise the team of panelists, given our understanding of the local banking sector, and more importantly, the wider regional and global banking sector? Is this kind of where we're seeing most of the banks seated at the moment? And that question can be answered by any of the panelists as well. Maybe Pravin, you can start from your South African experience, and then the rest of the team can respond as well.
Yes, so I'd say fairly typical in that we're seeing globally a lot of banks focusing on profitability and margin management. So the portfolio management as well as the profitability and pricing are common to everyone. Probably the only difference is, and it may be a function of the audience we have today, is the limited modeling on capital, because what we see particularly in Europe is the continuous change in risk guidance coming out of regulators, which means that they're continuously modeling on the capital modeling side. IFRS 9, I think, is reaching some degree of, let's call it, maturity for phase 1. I think there will be definitely phase 2 and 3. So that is to be expected. So I'd say not unexpected at all. And I think comes back to Sandeep's point about the maturity of the local market, that they actually quite far in development, and I would expect nothing less of the Kenyan market. So quite as expected in my mind.
Okay. All right. So question that has come in. Good insights, appreciated. Will the presentation be shared ex post? Definitely. So we are going to share with you the presentation. We're going to share with you our contacts. We are keen to have a conversation with you as well. So just write to us. We are happy to have a detailed conversation. We've begun some of these conversations with some of the people on the call, and we're very grateful they are on the call today. And we'd like to have a personalized and tailor-made conversation with you. So feel free to reach out to us. There's 1 or 2 more questions. I think this one I will ask Sandeep to chip in. there's been a lot of talk about a push to risk-based pricing and by extension, the scoring model. I think what the question is saying, is it good? Is it a good thing? The move towards risk-based pricing, is it a good thing? And is it a good thing for the customer, or is it a good thing for the bank? What's your view? Is it skewed towards the customer more or towards the bank more? This recent push to risk-based pricing.
Thanks, Seth. I believe definitely good for the banks. And being able to price based on the risk will improve their profitability and return to shareholders. And I just want to say that, banks in Kenya, in my experience in the recent past, have invested very heavily in efforts to improve their customer experience, but perhaps little to innovate on their pricing strategies. So I'm hoping that there's a lot more work that can be done there by banks. But yeah, is it good for customers? Again, I would argue that definitely good for customers, because risk-based pricing will improve access to funding for consumers. I mean, what we saw in 2016 when the interest rate capping legislation first came in was that although there was a good intention, I mean, the effects were completely counterproductive, because the supply of credit to businesses and individuals completely dried up, because banks were not able to price based on risk. So definitely good for the consumer as well. But importantly, because the credit score is a very key factor in risk-based pricing, if consumers understand and appreciate this, they can work towards improving their own credit scores to improve the pricing they receive on loans they take. So I believe it's a win-win for both set. And I'm hoping to see a lot of progress on this front.
A really good point you make, yeah, because we as consumers as well have a role to play in this wider thing, yeah, provided we have the visibility of the same. Really good comments, Sandy. Conscious of time as well, we have just a few minutes left. There's one or two remaining questions. Then I'll go around the panel to give any last remarks, and I think that will be the end. But it's not really the end, but it's the beginning. It's the beginning of a conversation on the banking sector with you. There's a question here, and I believe this must come from an economist, but I'll ask it exactly as it's asked. Kindly provide examples on how to measure customer elasticity to changes in price. So sure. I believe how sensitive is your loan book size to changes in the price. Pravin, you're nodding your head. I believe you want to take that one.
Yes. So what we typically see is firstly the banks tend to model it by segment, because different segments respond differently to changes in price. For some customers, convenience is more important than price. So service matters more. For other customers, price is critical. For other customers, purely access to credit is all that matters, and they are indifferent to the price. So the first one is we see the banks doing it by segment. What we see the banks doing is collecting time series of the application take-up rate. So of the loans that you approve, what is the actual take-up rate with customers? And often what we'll see is some of the more advanced banks running small samples of experiments within their base so that they can collect data of different pricing. So hypothetically, what they might do is on a particular month, run a slightly different pricing through one of their branches or one of their private banking suites, just to see the experience and measure the experience of other prices. They'll often overlay that with competitor pricing comparatives, so pricing differentials versus peer groups. The challenge with that is as the pricing models become more different, it's harder to respond and compare products across each other. But definitely the take-up rate by pricing segment and running small experiments to collect data of different prices is quite important. And then storing just at a heuristic level, so at a rule of thumb level, your knowledge of when opposite competitor banks run challenger models is quite important.
Super. And well answered. I think in this country as well, we've seen as exactly what you've said, yeah, different segments are responding differently. We have segments that just access, as you've put it, and they're ready to pay whatever it takes to get access to credit. So that's spot on. And I guess also the timing as well, yeah, around COVID period, we have seen different patterns from different segments of the market.
So just to add on the COVID one specifically, what you'll find is that a lot of banks will reflexively tighten lending in the COVID world.
Exactly.
To new customers. But that also presents opportunities to the few banks who are willing to lend limited amounts. If there's less competition in lending, you can actually put your price up a little bit. And again, it comes back to how much is too much. So what we saw in 2008 and 9, when we had the previous financial crisis, global financial crisis, is that one or two banks who were willing to lend were actually able to increase their margins in specific segments, not to everyone.
Ladies and gentlemen, we've come to the end of the session. I felt like we were just warming up and needed another hour. But sadly, we've come to the end of this. Allow me to get the closing remarks from each of the panelists, and then I will officially close the session. In no particular order, probably I'll begin with Wisa. Wisa, you presented. Yeah. I can't really tell if you're nodding your head without that.
Yeah, okay. Yeah, so to me, it's actually very exciting to see the responses of the poll that quite a good chunk of the participants actually involved at the pricing and the scoring bit of the product journey. And this is actually very, very key, taking into account the environment that we are in, COVID and post-COVID. And as per the question that was raised by Mr. Maina on the impact of suspension of provision of info to a segment of the lenders from CRB, and also then non-listing of either positive or negative performing accounts to the CRBs. So risk-based pricing at this stage is actually very, very important, because it now brings the banks to a situation where they need to actually use properly the data that they have internally on their systems, and the previous performance of their clients, to actually be able to predict what is the chance of the clients actually being a good customer going forward post-COVID. So this is the appropriate time, and it's the right time for banks and all microfinance institutions to adopt risk-based pricing, taking cognizance of the operating environment that we're in.
Thank you, Buisa. First mention of post-COVID. We will get there. We will get there. Sandeep, any last remarks from your end? Sandeep, I'm not sure if you can hear us. Okay, I'm not sure if Sandeep is there. If he comes back, I'll give him a chance for the last remarks. Pravin, it's been a pleasure as well, and with Wizard having you on the call. Any last remarks, Pravin?
Yes, so I think it's a very exciting journey. It is a challenging journey, but it is an exciting journey. My recommendation to every bank is to beat your own drum. While you have to watch the market, it's very important to have your own view as to where you want to win and what your strategy is. I think that is critical. You'll never win if you're not clear about your own strategy. And that is my advice to every bank: beat your own drum.
Thank you very much, Pravin. And from my end, my appeal to everyone is talk to us. Let us know if the session was useful. Let us know what you'd like to hear in the next session, and we will try and share as much information as possible. For those of you who have registered, you will get the slides. If you've not registered, please do so, and you'll be able to get the slides within 48 hours. Share the videos, share the slides. Let's begin this conversation. I'll begin by a very short message said by Deming, who's considered to be a very well-written scholar. Change is optional. Survival is optional. But if you want to survive, you have to change, and now is the time. Thank you very much, and that is the end of our session. Have a good day, everyone.
Thank you. Take care, everyone.